Hello, this is Steve Sinandro from the SRS Rock Report, and today what I'd like to do for members is I'm going to re-record a peak oil chat presentation I did a week or so ago, and I wanted to add a little bit more information. But this kind of summarizes. We're going to start here. Peak net oil energy finally arrived on the global stage. Now, I did an update on that, but what I want to do today is show how it's going to impact high technology and asset values, because all of us use technology and all of us, we have assets. We either have stocks, we've got retirement accounts, 401ks, we also have own homes. So I believe peak net oil energy is going to impact high technology and asset values. So let's get started. Now, the first slide here is just kind of a refresher going back to this same thing happened during the late Bronze Age civilization when they cut down a massive amount of wood to make charcoal, to smelt copper, and also tin to make bronze. But they also cut down trees for cooking and heating, building and shipbuilding. So we had peak EROI, peak wood fuel production was the reason for the peak of the Bronze Age civilization. And this is, I also talked about the Roman Empire. They also did the same thing on a much larger scale, because this was also, not only did they cut down a lot of trees to make silver and lead, to smelt silver and lead, they copper, gold, even iron. This was the Iron Age. So they cut down a lot of trees to make charcoal to smelt iron. And again, they also cut down trees for heating and cooking and building ships and construction. So we had peak ERI of wood fuel in the ancient times in the Roman Empire as well. And again, a lot of this information came from the Forest Journey, Wood and Decline of the Roman Empire. I talked about that. And what's interesting, what we see is it impacted asset values because we had the devaluation of the Roman denarius, which was a silver coin, but that was not due to just emperors wanting to debase the currency. It was due to the collapse of wood fuel production, which led to the decline in silver production during the later stages of the Roman Empire. And again, we could see this. Again, I'm summarizing. We had 200 metric tons a year of silver production during that 50 BC to 100 AD. But then as the wood fuel production decreased, we see it fall in half to only 100 metric tons from 100 AD to 200 AD. And then it falls by a third to only 30 metric tons a year. And when this was going on, they were using less silver in the currency. So peak net wood fuel impacted the silver value in this coins. And lastly, before I move to current times, all of this cutting down of forests and using farmland, we had massive deforestation, soil erosion, and collapse. So when a lot of tourists go visit these ancient sites in the Mediterranean, North Africa, basically it's a lot of denuded areas, and this continues to today. Now, I wanted to start here, and let's get a close-up of this. Just to summarize, plummeting energy return on investment of oil and the impact on the global energy landscape. Again, which is highlighted, the global energy landscape is facing a crucial turning point. Various studies show that oil liquids production is expected to peak about 2035 at a magnitude of 5 petajoules a day. That's a lot of energy. But when the energy required for the extraction and production of these liquids is taken into account, the net energy is supposed to peak about 2025 at about 400 petajoules. Thus, where the red arrow is showing, EROI starvation leads to energy cannibalism, and that's what's taking place. Now, I mentioned this when I first did this update. This was the peak oil and low carbon energy transition, a net energy perspective, and it was written by Delany, Longretti, Murphy, and Prados. Now, David Murphy is a student of Charles Hall. Charles Hall was a part of that peak oil chat, and I have been corresponding with him. He actually wants to start doing some more collaboration on showing how all this finance, how we can convert that into the EROI. But this report only had 2,515 reads. This thing should be getting tens of thousands, hundreds of thousands, millions of reads. It's very important. The energy return on investment is very important. Now, if we look at the next chart, This is the important chart right here. Basically, that large area, as I explained, on the top, that is the oil cost of the oil energy that's below it. And the dark gray area, that is the onshore conventional. Then the light gray is offshore conventional. And then we have all the other colored areas, including NGLs and shale oil. But what we notice, even if overall production shown on the top where the oil cost chart area is, it peaks about 2035. But the net energy starts to roll over. It's peaking now, and then it really starts to roll over in 2030. This is the net energy cliff I've been talking about. And I mentioned also that this report was pretty robust. They had oil production model selection. They had 8 criteria, which is shown in that red box. They picked global shift. It had a score of 8. It met the best criteria, and they are suggesting peak of overall liquids, which includes tight oil, even natural gas liquids, about 2035, plus or minus. That's up for debate. But if we look forward, according to global shift, liquids is supposed to peak in this red highlighted area about 2035. But by 2024 is what we're going to see peak net energy. So we're there. And these guys, these 4 different authors of this report, they looked at all the different EROI factors for field oil, onshore natural gas liquids, shale tight oil, tar sands, offshore, onshore. They went through all of them to get this report, which basically summarizes what we see on the chart to the right is the ERI is falling, or it's going up. The cost of energy to produce energy is going up exponentially. And they suggest by 2050, it's going to be 50%, which is a 2-to-1 energy return on investment. We get into trouble, as Charles Hall has suggested, when we fall below 10-to-1 energy return on investment. And so I took all this data, as you remember, and I put it on my Get Data digitizer, and I came up with this chart. The net energy is shown in the kind of tan bars, and the oil cost, is shown in the red. What we see, it's peaking at about 2025. It plateaus, and then it really starts to roll over by 2040. This is when we start to get into trouble. And I believe we are starting to, because I just did an update, which you're going to see about the global debt increased 21 trillion just in the first half of 2025. So I think we're already having issues, but it's going to be very apparent after 2030. Now, taking that data, this is the ERRIs. In 1970, we had 40-to-1 energy return on investment of our oil. But it really started to decline. And right now in 2025, the data suggests we're at 5-to-1. Well, this is why we're seeing debts increase so much, because we're below that 10-to-1 kind of minimum that runs the entire high-tech global economy. So I think we see by 2050, the estimate is it's going to be 2-to-1, but we're going to get into trouble, I believe, starting in a big way in 2030 and afterwards. So this is it. Now, of course, correlation does not mean causation, but it is interesting to see the rapidly declining EROI, especially in 2010. Look how the debt has been going up. It's now at 325 trillion. Wait till you see my update on the debt increase in the first half of 2025. It's much higher. But see, we're already at 5-to-1. So we're going to see more debt to offset the continued falling EROI of oil energy. Now, this is where I'm doing this update. I've talked about this before. I just did a summary. But now, how is it going to impact technology and asset values? Now, the oil industry's escalated depreciation. This is the Red Queen syndrome I'm talking about via massive depreciation. And what's depreciation? It's only the accounting of what's happening. It's the financial accounting, what's happening in the real world. And that is the depreciation of assets or declines of ore grades. And what we see on this chart on the left is a typical conventional oil well decline curve, 33% by the 3rd year. Look at the typical shale tight oil well. It's 80% by 3rd year. So this transition to tight oil is done by massive depreciation. And we're seeing that also in technology. I'll show you that in a minute here because, again, I'm using Riot platforms because President Trump suggests that the US is going to be the Bitcoin capital of the world. But when you look at the massive depreciation of the Bitcoin miners, which is 90% by the third year, it's very similar to the depreciation and decline we're seeing in shale oil wells, which this is what we're moving to. We're moving to things that depreciate and decline much quicker. So I've showed you this chart, but putting it all together, this is the four Bitcoin miners' revenues versus depreciation. The revenue is shown in the Bitcoin bars and the depreciation is in red. And what do you see? It's 57%. That's the last reading, 57%. I mean, this depreciation is underreported because as I've reported, they're using 3-year straight line depreciation. They should be using that exponential decline rate, which is like it's 75% first year, 10% more the second year, and then 5% more the third year. So the depreciation is front loaded, and they're not showing that. Now, if we look at the gold miners right now, it's 14% depreciation. But if you look over the last 4 or 5 years, we could say it's below 20%. The Bitcoin miners, it's triple that. It's almost 60%. So this is and it is 60% because they're underreporting it. So I'm just showing how technology it's breaking down. It's depreciating faster than the mining industry, which is it's a very high depreciation industry. They're going through a lot of capital, a lot of equipment, and a lot of they're losing their ore grades. They're depleting the mine. Now, let's move to this. Data centers, AI, GPUs, may have an extremely short lifespan, and the data shows it. In the highlighted area, operating rates for GPUs for AI processing data centers have reached a 60 to 70%. In this high load environment, the lifespan of GPU is estimated to be only 1 to 2 years, at most about 3 years. Again, this is similar to the Bitcoin miners. So what we're seeing is technology now, and we're moving to AI. And I had the update, and I showed 3 different YouTube videos. If you did not see those, you have to see these, especially this one, how AI data centers eat the world. What's happening is unbelievable. And if we look at this next chart, this next slide, I mean, there is a stunning financial problem with AI data centers. Add it all up, and it's not on data centers' side. The financial gurus estimate that AI data centers to be built in 2025 suffer 40 billion of annual depreciation, while generating somewhere between 15 and 20 billion of revenues. This is the problem. The depreciation is going to be very high, just like the Bitcoin miners, but they're not making money. And if you look at the lower part, given the current rate at which tech companies spending money without much return, a long-term bet that AI will all but make human labor obsolete, Kupperman estimates that revenues would have to increase tenfold for the AI data centers just to break even, which is impossible, of course. So I think there's a lot of problems coming with the AI data centers due to it's an exponential increase. If we thought technology was increasing faster, it's changing faster, we thought that was bad. AI data centers is an exponential trend. It's moving up even quicker. So I'm transitioning now to high-tech space because a lot of people have seen Elon Musk's spaceship launches, and we've had several disasters there. They're trying to learn. But as I mentioned, the Starship is bigger than the Saturn V. And I know about the Saturn V because I lived in Cocoa Beach, Florida, when the Saturn V was going off. My father was the head inspector on the space shuttle for many years. And I had the wonderful opportunity to spend a summer with Don Arabian, retired Don Arabian, who worked for NASA. Especially, he was the head of the mission evaluation room in Houston, Texas, which that's where all the problem solving took place. It didn't take place in the Kennedy Space Center in Mission Control in Cape Canaveral. It took place with the engineers in the mission evaluation room in Houston, Texas, and that's where Don Arabian was. Basically, he managed the whole system. So what's fascinating, He believes that we're going to be in he believed that we're going to be in serious trouble due to putting nuclear power. He said you can't trust humans with running nuclear power plants. It's like taking the power of the sun and putting it in your backyard. And unfortunately, we tend to put profits over safety, and this could be very problematic in the future for nuclear energy. But this is the problem with SpaceX. It's too expensive. If we look at the different modes of shipping costs, and I've shown this chart before for members, rail is the cheapest. It's 60 cents to $2 a kilogram to transport something. Ship is $2 to $3. Truck is 2 to 4. Air is like double. It's 4 to 8. But SpaceX right now is 1,500. Now they want to increase the number of SpaceX ships. They want to become a little bit more efficient doing it. They want to lower that. But the problem is most of the shipping is done by ship transport. 70% of our stuff that we use in the world is done by ship transport. 18% is trucking, 9% rail, 2% inland water, and only 1/4 of 1% is done by air transport. Can you imagine how much is going to be done by SpaceX? It's just too expensive. And if you're old like me, I watch Star Trek and Star Wars, and this comes from Star Wars. So sci-fi spaceships is pure fiction, and I do watch science fiction, especially the new Expanse that was on Prime. Very interesting new science fiction based on mining asteroids and all these space centers and spaceships in the future. But the problem is, and this is some of the data from the Imperial Star Destroyer for Star Wars, the estimated cost would be 44 trillion. It's a mile-long ship. And we do see mile-long ships in these sci-fi movies. The annual cost and depreciation is 3 trillion because these things break down just like a refrigerator, a car. Estimated cost of the Exeter was 308 trillion, and its annual cost and depreciation would be 22 trillion. So while we have a fascination with massive starships in space in the future, I don't think it's realistic. So I bring it back to this. This is the current situation. The U.S. Navy cost and depreciation. Aircraft carriers and destroyers cost an arm, leg, and a foot. A new Gerald Ford class aircraft carrier is 13 billion. Now that's the cost of brand new. It is probably rising. It's going to be 14, 15 billion now to build a new one. The problem is the annual cost and depreciation to run it is 1 billion a year just to run it. Now the Arleigh Burke class destroyers, the estimated cost is 2.5 billion. The annual cost and depreciation is 140 million. Now the issue is we tried to move to a high-tech destroyer, which is the Zumwalt, and they canceled it due to high costs. There was a 2.5 billion each, and the problem is the technology was too difficult. The problem from engineering, and again, we're just putting a ship on water. This is not putting something in space where you have to have oxygen. If there's no oxygen, then people will die, and you have to recycle everything. The wastes have to be recycled, and this stuff has to be constantly maintained. How are you going to do that when these ships are out there for years? So this is the problem. I think the idea of moving to high-tech space, moving to Mars, the problem is what Don Arabian told me. He said, you can't destroy this planet as a reason to move to Mars. You have to be able to solve living sustainably on this Earth with its natural systems before you can move to deep space or Mars. But getting back to this, because how peak net energy is going to, I'm showing you how it's impacting technology. We cannot move out of space with technology like AI data centers that depreciate. They're basically run through in 1 to 3 years. We need our technology to last a long time. And I think if there is alien and other life forms in different solar systems in the universe, they have solved their technology, does not break down this quickly. I think this is a major problem that we're facing. But again, as I talked about this, the collateral trap, I spoke about this in the Silver Symposium. The United States Treasury is the foundation of the financial system. And this is amazing because in the footnote that I talk about, The authors of this report say, to be clear, in our model, we abstracted from sovereign debt risk, which, like the UK gilt, we had problems in 2022, and considered treasuries as being safe assets. They did not prove that they're safe assets. They just considered them safe assets. And I don't think they are over the long term. Because why? Well, it comes down to this chart. This is the last chart. This is the estimated cost for various collateral types, US Treasuries versus gold and silver, based on $100. I'm making it simple, $100 of US Treasuries. Well, there is no cost to make a US Treasury. It's a digital Treasury. So it's basically, there's zero cost to manufacture it. There's no energy really, there's no labor, maybe a little bit of labor, but the cost of a Treasury is the servicing cost, which is about 4%. That's the interest rate. So it's $4 cost for a $100 treasury value. That's it. So it's basically you $96 of profit there. The issue is when you look at the gold miners, it's over 25 years. It's about an 80% cost. So 25% profit. This cost to produce this collateral, which is gold, because gold can be used as collateral. It took a lot of labor, which I'm doing a report on that, a lot of labor, materials, and energy, raw energy. But when you understand labor is human energy, materials come from capital, human labor, which is energy, and energy to make those materials. And then there's the raw energy. So basically, it's energy in all forms and stages that makes the cost of this collateral, which is 80%. And silver, it's 90%. So I believe in the future, as we hit energy constraints, the real valuable collateral is going to be those assets that take a lot of energy in all forms and stages to produce them. So I hope you found this information interesting, kind of a summary and putting it all together, especially how energy, peak net energy is going to impact high tech and asset values. I don't think the market is ready for this. I think, especially in the next several years, it's going to start to become more apparent. And after 2030, as the net energy cliff starts to fall off, I think the world is going to have to realize they're going to have to protect wealth. And that is very hard to do in typical financial assets, such as stocks, bonds, and even fiat money. So I hope you enjoyed this. If you have any questions or comments, please leave them in the comment section. Thank you.